Diana Shipping Inc., ticker DSX, just posted a massive beat on both top and bottom lines for their Q2 2026 earnings, though tracking platforms definitely disagreed on the exact consensus.
Yeah, they reported a diluted EPS of 16 cents, which completely crushed estimates that were, ranging anywhere from 2 cents to a maximum of 10 cents.
And the revenue numbers.
Just as hot. Time charter revenues hit $57.3 million. That comfortably beats the expected $54.6 million, and it's up 4.8% year over year from Q2 2025.
Right. But we really have to talk about the guidance, because that seems to be what poured gasoline on the stock. They locked in $94.7 million in contracted revenues for the remainder of 2026.
That is a massive chunk of their availability.
It really is. For you as an investor, that means 88% of their ownership days for the rest of the year are already fixed at a robust average of $18,337 per day. And they've even secured 25% of their 2027 days at $18,807 a day.
And the market absolutely loved it. DSX popped 7.48% during the regular session on July 30th, closing at $2.30.
Then gained another 5.65% the very next day.
Exactly, closing at 2.43. We actually saw Wall Street Zen immediately upgrade the stock to a strong buy based on that momentum.
So we know the headline numbers beat expectations and the stock popped, but we need to peel back how they actually achieved that bottom line growth, because they actually operated with fewer ownership days this quarter due to a vessel sale.
Right.
How do you generate top-line revenue growth when your physical fleet is actually smaller?
Well, you have to squeeze near perfection out of your remaining assets. They currently operate a fleet of 36 vessels, and the average age is 12.5 years.
Which is getting up there for shipping.
It is, yeah. Usually past the 10-year mark, you see a lot more downtime for maintenance. But despite that, Diana achieved a 99.6% utilization rate for the quarter.
Oh, wow. So those ships were just moving cargo nonstop.
Basically, yeah. But utilization alone doesn't grow revenue if the rates are flat. The real driver is that they were moving cargo at higher daily rates. Their time charter equivalent rate, the TCE, rose 7% year over year to $16,581 per day.
So that's the clean number showing what a ship earns daily just for being leased out.
Exactly.
But let me jump in here and push back a bit, because looking at the expense side of the ledger, there's a definite creep upward. Vessel operating expenses rose to $6,396 per day, up from $5,944 year over year.
Yeah, management blamed higher crew and maintenance costs. You have to pay more to retain crew, and parts for older ships are just more expensive now.
Right, but here's where the math really falls apart for me. You just said their TCE rate, their clean daily earnings, was $16,581.
Yeah.
But if we factor in all their costs, the OPEX, the general and administrative overhead, and debt amortization, Diana's break-even rate is actually $16,859 a day.
It is.
So the break-even is higher than the earnings. If the TCE rate is lower than the break-even rate, how on earth did net income surge 362% year over year to $20.8 million?
Okay, so this is the crucial caveat hidden in the earnings report. That massive EPS beat wasn't driven by moving dry bulk. It was heavily padded by a $14.3 million gain on equity securities.
Wait, really? A paper gain?
Yes. Specifically, their 14.4% stake in a rival company, Genco. Under accounting rules, if that equity investment increases in market value, Diana has to recognize it as net income.
So for anyone listening, this quarter's massive profitability is way less representative of recurring shipping cash flows. Their actual shipping operations are barely breaking even.
Exactly. They maintained their 1 cent per share quarterly dividend, payable September 11th, which kind of signals they need to retain capital. They aren't swimming in operational cash.
Which means their future relies heavily on global macro conditions pushing those daily charter rates higher.
Right, and CEO Semiramis Paliou highlighted this. She pointed out that geopolitical disruptions and canal constraints are stretching ton miles.
Meaning the Red Sea rerouting.
Yeah. Ships are forced to go around Africa. This ties up vessels for weeks longer, artificially tightening the global supply of ships, which props up freight sentiment.
It's basically a clogged highway. If you own delivery trucks and a major bridge collapses, everyone takes a massive detour. That traffic jam is ironically great for your pricing power because your trucks are occupied longer and capacity drops.
That's a perfect analogy. But management also flags some distinct looming headwinds.
Because if the traffic clears, rates plummet.
Precisely. They warned about elevated fleet growth on the horizon, specifically a wave of new Kamsarmax and Ultramax deliveries hitting the water soon.
And demolition rates for old ships are at historic lows.
Exactly. Nobody is scrapping their old rust buckets because current rates are just good enough to keep them running. Add to that a slowing Chinese GDP, it dropped to 4.3% in Q2.
And China is the engine for dry bulk demand.
Yep. Plus, they flagged potential limits on bauxite exports from Guinea in the second half of the year.
So Diana has razor-thin margins, a softening macro environment, but they are sitting on $117.9 million in cash, which explains why they think the market is distracted right now and why they're in this increasingly bitter, hostile takeover battle for Genco shipping and trading.
Oh, the Genco drama is wild. Diana's initial all-cash tender offer of $24.80 failed completely. Only about 27% tendered.
So what's the new play?
They have a revised, non-binding proposal out there. It's $24.80 in cash, less any dividends Genco pays, plus 1 share of Diana stock. They claim this totals an implied value of $27.34 per share.
I'm sorry, I have to question Diana's math on that stock component because Genco's board is definitely urging shareholders to reject it.
Oh, they hate it.
Well, yeah. Genco points out Diana is valuing its own stock at 2.54 in the deal, but Diana was trading at 2.30 on June 16th and down to 2.20 on July 22nd. It's literally like trying to buy a house with a check you wrote yourself and insisting the currency is worth more than the bank says.
That's exactly Genco's defense, and it gets worse. Genco warns that to fund this, Diana plans to sell 16 Genco vessels to Starbulk at below-market prices.
A fire sale.
Basically. Plus, Genco highlights that Diana's insiders hold high-voting preferred shares. Meaning, if you're a Genco shareholder taking this deal, you would have severely limited rights in the combined company.
But Diana didn't just take that lying down. They launched a counterattack, right?
Oh, they went straight for the throat. Diana released independent vessels value data showing Genco's fleet actually declined $50 million, about 3.4% since June.
Wow.
Yeah, and they accused Genco of suddenly changing their valuation methods to use sell-side brokers, just to artificially inflate their NAV by $2 a share and make Diana's offer look bad.
So it's all-out corporate warfare over what these assets are actually worth, which actually ties perfectly into a really provocative macro concept that CEO of Semiramis Paleo mentioned.
The shift in minerals, right.
Yes. She said, quote, minerals are increasingly shifting from ordinary commodities to strategic national assets.
That is such a fascinating point. When resource-rich nations use export controls as leverage, like we might see in Guinea with bauxite, the whole game changes.
Exactly. So for you as an investor, you have to ponder how this geopolitical shift might permanently alter the valuation multiples of dry bulk carriers like DSX.
Right. Do they move from being just cyclical trades to being vital strategic infrastructure?
That's the billion-dollar question. If they're strategic infrastructure, the premium on these companies completely changes. But that's all the time we have for this deep dive. Make sure to follow the show for our daily earnings coverage, and we will catch you next time.